to the Capital Discussions Kevlar April 2016 Trade Review. I'm Tom Nunemaker with Jim Riggio. Before we get started, a quick disclaimer. The Capital Discussion is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, then let me switch out of this and into, there we go. So Jim, welcome. Nice to be back for another Kevlar trade review.
Thank you, Tom. Tom, on the presentation, I looked at it. If we go down, do we have the overview, the rules?
Not on this point.
Oh, okay. What I wanted to end up doing is just kind of end up going over those real quick. Thank you so much. That's exactly the slide that I wanted. I just kind of wanted to end up going over the Kevlar, what we try to end up doing, and a quick overview of what the objectives are and how we end up approaching this. What we're looking for here in the Kevlar is a way to be able to end up managing our risk. Tom and I were just reviewing beforehand, and the two biggest risks, because every trade, no matter what you have an area of what, you basically, I always look at it as you're trying to play defense. You can't cover 100% of the field, right? You can't end up accounting for every single instance. So what are the biggest risks? To the Kevlar, and we designed it this way on purpose, the Kevlar will end up suffering, okay, if we have a 1987 type of crash and volatility goes up, to 100. There's definite risk in it, depending on which model we use. Remember, because we have two models. One's with a balanced butterfly where we buy long calls, and another one where we have an unbalanced butterfly, or some people call them broken wings, they prefer to, where I'll have a lower wing that is longer than the upper wing. In that case, what will end up happening is that there'll be more risk when we have a crash type of scenario. The second environment that is difficult to end up managing is that when you have a pretty significant move up. And as you'll see when we end up reviewing this April trade, I think the 160 or 170 SPY points that the market moved up during this trade would be considered, okay, that second part. 160 point up in an S&P move over the life of a trade is a difficult thing to manage. So what we end up doing is the key objective is if one of these types of difficult or any market environment happens, how well can we preserve capital? And you'll get to see that. I mean, you'll get to see what the risk looks like on the upside when we have the second most challenging type of environment. The other thing is that I don't want to have to end up managing this more than once a day. I'll look at it a few times during the day, but if I'm going to make a trade, it's usually always going to be in the afternoon. The other thing is we end up saying, well, where are we going to end up, okay, trying to make? In a perfect environment, okay, for the trade, in either of the two models, we're going to look to make, somewhere between 5 to 10%. I want the trade to be resilient, and I want to end up having it be resilient in both environments. And again, okay, you'll see the dual model here, one for high volatility, okay, with a flatter skew, and then another one where when the skew becomes a little. Remember what skew is? It means that the puts, the implied volatility of the puts below the money, is higher than the puts at the money. How much more? Well, if it's much more, and you kind of drew that as a line, that would mean it would be a steeper put skew is the term that we end up using. If the implied volatility of the puts below the money is relatively close to that of the puts near the money, we consider that to be a flatter skew. I will tell you that the majority of the time, probably at least 90% of the time, put skews become flatter when the market drops and all IVs go up. What happens is that the IVs at the money go up much quicker than the IVs of the puts well below the money. Okay, that's pretty common in the market. And the other thing is that sometimes I will use two Kevlars on different months, and I'll end up playing their deltas off. I'll always look at them as a risk of the overall risk. If there are any questions for that, please write them in, but I'm going to end up keep moving on right now. But that's how we end up approaching. Tom, if we go to the next slide. Here's where we've done, as I mentioned, we were able to make a small profit, okay, on this Kevlar. We were losing money for most of the time because of, as I said, the difficulty in the market chugging up. And that's just a fact. That's what we'll end up always having to deal with. But I was happy that we were able to actually eke out a small 1% or so profit on this. And so we've kept our string going for 5 straight months here. Okay, if we go to the next slide, the next one. We started the April Kevlar on the 19th. The market was around 1915. You're going to end up seeing it in a few charts, but the market had sold off. It had bounced a little bit, and it was fearful that the market was going to end up continuing to turn down. Having the market end up moving down and having volatility spike up, things just move a lot faster. So you'll find that I guess most traders or professional investment guys are always more concerned about the downside than the upside. So it is a bias. What I ended up doing here is I started with 16 contracts. What I let you know before is that I will try to always make this so that the trades are divisible by 4. It won't always work. If I have to change it, I will. But so that instead of using $50,000 in your modeling, if you'd like to end up using, say $12,500 to $15,000, maybe a little bit more in your modeling, you'd be able to end up dividing this. Very simple, very normal way, the way I like to start the trades with the delta and the Greeks. What you'll see here is that I actually had the butterfly, when we show you on the next graph, it's just inside the upper put, meaning my upper put is at 1925, and the market was at 1915 or so, about. So with that, we are a little bit negative delta, and you can see that just from this graph. The dotted line, not the dashed line, but the dotted line, which is the T+0 line, you'll see that it actually makes a little bit of money as you go down, and you lose a little bit as you go up. But remember, what ends up happening is that because it is a negative Vega trade, if we go down and implied volatility goes up, while OptionView does a reasonably good point of trying to estimate how that volatility will end up affecting the P&L, it has been my experience that the dotted line to the left will not make as much money as it's predicting if the volatility moves higher. And higher, but I mean, if we're starting at a very low IV, that's an issue. Now here, in this environment, because we've had a sell-off and implied volatility was already a little bit higher, it's probably pretty accurate. These are the nuances that when you're trading, you need to end up knowing how your trade will end up morphing and how it will respond with both price and volatility movement. And remember, volatility movement has 2 pieces. One is the overall IV level, the VIX, if you will, and 2 is the relationship of the puts at the money versus below the money, and we call that one skew. Okay, so you can see that because the implied volatility was a little bit higher and skew was a little flatter, of the 2 different options that we or the 2 different models that we can end up implying, I ended up using the broken wing model, where the lower wing, or the put credit spread, if you prefer, is 25 points longer than the right wing, or the put debit spread, if you'd prefer. The put wing is 100 points on the downside. The upper wing is 75 points. That is a typical way that I'll end up doing this. I spent overall, because I know that sometimes it's difficult for you to end up looking at the option view because it doesn't tell you how much you paid for the spread, right? This butterfly cost me $6.75. Okay, that's an important number, and that's a number that I will look at all the time when I'm managing this. I got asked by Robert Esposito that sometimes I trade irons, okay, and broken wings. Yeah, what I ended up doing, Robert, is that normally the way I had traded this before I was letting everybody follow me, I would always use irons, okay, in this environment. I will tell you that your execution really shouldn't matter. What you will do is you will see a much higher spike in your daily P&L if you're watching it, if you use deep in the money options on either side. So if I have a deep in the money call, okay, because the difference between the bid and the ask will be wider, anybody who comes in who's trying to end up, okay, purchasing or selling that option and it goes in between the wide bid and ask is going to have a greater influence on what the mid price is. And therefore, that's going to be reflected in what you see on your screen. It's not what you can actually get. Okay, it's not the real value, okay, of the spread, but you will see a much bigger. So what I ended up doing here was that I used just put spreads almost all the time, put butterflies, because they're easier. They're all below the money. You don't have as much variance. People can end up seeing them better. The only downside of this that I end up seeing is that you actually pay for this. So if if I have a $50,000 account and I'm using the $50,000 and it's all in cash, no problem. But what happens if you have a bunch of, I don't know, marginable closed-end funds that you're getting interest from and you have no cash in the account and you want to trade this on top of that? Well, if I use irons, I get a credit, so I'm not paying any margin interest. Okay, that's the reason why I would use irons. What would I consider to be flat? I use a institutional tool, and we measure everything within standard deviations of the norm. Okay, and so what I would consider to be flat is that when we are, at least a half of standard deviation below where we are, one standard deviation definitely. Back in early January, we were 2 standard deviations flat. To answer your question, though, of how you end up seeing this, right now, for example, if I take a look, we're relatively steep. That's because if I take a look at the puts, and let's take a look at June, okay, because that would be the one that I'd be opening. Tom, what I'll do is that, you know what? Let me do this. Let me come back to that at the end, and I'll go through examples of flat, and I'll show my screen afterwards. But let's get through the trade first. Okay, so what ends up happening is we put on this trade, okay, we're at 19.15, okay, and I have to end up worrying a little bit if the market goes up. The nice thing about this is that, yes, I do have my $50,000 of margin or so on the downside if we end up going down, but you can see even if we go to infinity or beyond, I only have about $12,000 at risk, right? So I only have a quarter of the risk to the upside that I do to the downside. If we go to the next slide. So you can see that if we move up, okay, slowly, okay, as I get into expiration, I should be, in very good shape. If we move down, okay, and even down significantly below the bottom, I still have a lot of room to the downside. So obviously I have a much tighter, okay, P&L that I have to be careful of on a move up. I tend to end up always trading that way because we tend not to crash up at the speed that we will crash down towards. Okay, so if we keep going, next slide. So here was the trade that we ended up having to adjust, okay, after we put the initial trade on. Here what you'll end up seeing is that the market had moved up from 1915 to 1978. So the market's moved up more than 70 points, okay? That butterfly that we had paid $6.75 for, I've lost over $1 on it. It's only trading at $5.65. At this point, Okay, we are above the entire butterfly. Remember, my butterfly was only at 1925, so we're well above the whole butterfly. I've been very patient. I've waited for an opportunity for it to come down. It hasn't. We're only down $1.10 on the butterfly, so it's time to take half of them off. Okay, so you can see what I did was by taking half of my butterflies off, I cut my theta in half. Um, my gamma is still relatively flat. It's under 2. And what I ended up doing, oh, I'm sorry, this was half of the adjustment. And then what I ended up doing after this is that I ended up rolling half of it up. Tom, if you go to the next slide. Okay. So you can see what I did now here was that of the of the 16 flies that I had, I cut them in half. I only have 8, and I put in a quarter of that initial position. So what's left, I rolled half of them up, however you want to look at it. So I put a new butterfly on, and at this point, if you take a look, the lower wing is 100 points, right? It's between 1950 and 1850. And the upper wing is only 50 points. The reason why I've done this is that I needed to get my deltas under control. Okay, so I've dropped my deltas before the entire trade from 84 down to 31. So I've managed them well. More importantly, I've really flattened out my T plus 0 line. My gamma is actually negative at this point, and I've helped my theta. Okay, the position might have been a little bit strange. Okay, for some of you, if you go to the next slide. Okay. What ended up happening here is what you'll end up seeing is the double butterfly, right? The new one that I had put on, okay, which is only half on the right hand side, which is only half that of the left. Sorry about that, guys. Anyway, so you can see my T plus 0 line, which is the after trade, is the green line, is still very, very flat. I can end up having the market pull back, 80 points or so before I have to worry about anything. Of course, if the other position was basically getting to be a unidirectional bet to the downside. So I wanted to end up flattening this out. At this point, I'm already concerned about this. We're down money on the trade. So I ended up reducing the margin. And the way you can see the reduction of the margin is if you look at the lower left-hand side of the risk chart. The blue line was the trade, was the line before we made the adjustment. And the green line is the one after. So having the green line be higher than the blue line meant if we ended up losing money because the market ended up crashing at expiration, that we actually took some risk and some margin off of the table. I tend to end up liking to make adjustments most of the time where I can end up reducing my margin for 2 reasons. 1, it has less risk. 2, if later on, if I need to end up adding anything on the left-hand side because we moved even higher, I have that flexibility. Okay, if we go to the next slide, Tom. Okay, you can end up seeing here that since we put this on February 19th, okay, the market's, and at 1910, it's basically it's moved up. It's very volatile. We have put our zone a little bit higher, but if the market stays here and moves up, my risk is well contained, but I'm going to end up losing money. And at this point, okay, with this amount of volatility, a lot of times you'll see it, it could go up, even if it goes up incredibly high, my max loss is well managed. Okay, and if it does pull back, okay, it comes back into my profit zone. Okay, if we keep going, Tom. Okay. On here, what you can see, what I ended up doing is that the market moved even higher. Okay, we went up from, the 1880, 1890 areas out to above 2007. So what I needed to end up doing here was that I needed to end up selling. Remember, we already closed out half of our initial butterflies. Those are the bottom 3 strikes. It's time to end up closing another quarter of them. So I'll only have 1 quarter left, right? I'll only have 4 of them left. Remember, we originally bought that butterfly for $6.75. I sold it the previous day at $5.65. Now it's gone down to $4.20. So it's time to end up getting rid of them. Mostly, right? Mostly because I don't want to end up carrying all of those negative deltas. Not when I'm reducing my margin. And by the way, by reducing my margin, I'm going to end up by selling this. I'm going to take more risk off the table. My loss is 7.1% off of the margin. It's a 5.6% at this point off of my planned capital of $50,000. Okay, so I'm down roughly 5.5%, but I have very little risk if we continue to move up. Okay, it's not like I'm going to get hurt badly. So having patience and staying in this trade, hoping that we comes down is where I'm going to end up staying. Okay, so Tom, if we go to the next slide. So this is the structure, okay? What we end up doing by selling that lower butterfly, I've taken the whole, tent that I had on the left-hand side, and I've totally flattened it out. But you can see in the dotted lines here that in my T+0 line, I really haven't given up a huge amount of potential profit if we've moved down. And look at what I've done. I've reduced my risk from, maybe $47,000 down to about $35,000. So I'm taking money off the table. My theta is still positive. I still have a chance if we end up pulling back. And if we go up, you can see, look at what happens with the green line if we go up. Where before I had maybe about a total, I could lose maybe $6,500 if it went to infinity and beyond at expiration. And so here I ended up lowering my risk to the upside also. So overall, I'm just buying time, hoping for a pullback, collecting a little bit of theta, and if it runs up, we're going to end up staying where we are, losing a few more dollars, but nothing devastating. Okay, very important. Okay, way to end up managing it. Okay, next slide. At this point, we were hoping for it to go down from 2007 or so, and instead of it going down, it went up another 40 points. Okay. At this point, I cry uncle. Okay, I close out the bottom butterfly. I only get for that bottom butterfly, I only get $1.55. Remember, we originally bought it at $6.75. We sold half of them out at $5.65. We sold a quarter of them out at $4.20, and now we're closing out the final quarter and only got $1.55. Okay, but what we ended up doing at this point is that we ended up also needing to roll higher. So the existing butterfly that we had that was centered at 1950, I'm going to end up rolling that whole piece up, okay, and we're going to basically turn it into a butterfly that's going to be centered at 2025. If we go to the next, well, by the way, just again with the Greeks, okay, real quick. People saying, Jim, you did all of this stuff and you really didn't do anything with my delta. No, I didn't, okay, but what I did do is that I lowered my gamma, so my gamma is yet negative again, okay, and I ended up taking a look at the theta, and I ended up increasing the theta, okay, so very, very important what I was able to end up accomplishing there, okay. Okay, now if we go to the next one, Tom. So you can see what I did was that I closed the old trade, I put the new trade in, okay, the delta, which is the slope of the dotted lines, right, the dotted blue and dotted red lines, the slope isn't much, and now I only have maybe, 60 points to the downside where before I felt like I had hundreds, and so now basically it is almost a brand new trade, okay, that I am hoping that I can hold on to this within a range of maybe, 40, 50, 60 points to the downside, something to the upside, and if we can end up staying in here and collecting theta, we'll be good. We just have to have the market stop running up at this point. Remember, we started at 1915, and the market's now at like 2050. So the market's up about 135 SPX points since we put this on. Okay, if we go to the next one. And does it stay at 2050? No. It goes up to 2070. So here was, again, it's just a constant battle of what ends up happening when the market just keeps going up. I have to now reduce my theta, reduce my delta again, get them to be less negative. I need to end up increasing my theta because we're getting closer to expiration. Going back to Robert's question early on about when do I end up using irons, Robert, notice at this point I've switched from using all puts to having calls on the upside. The reason to switch, even though it's not as easy for everybody to end up seeing here, is because as I get closer to expiration, I don't want to have those huge swings in what I end up seeing in my P&L. It's a lot easier, okay? You'll get a lot more people to work with you with out of the money spreads when you're in the last couple of weeks of expiration than you will, say, doing deep in the money spreads the last couple of weeks before expiration. So I did switch here, okay? And you can end up seeing the new position is it's basically an iron condor where my shorts are at 2080 on the call side. My shorts are 2025 on the put side. So a reasonable range, 55-point range that I'm hoping will stay somewhere in between here. If we just get a little bit of a pullback, right, we're at 2070. All I need is a little bit of a pullback, okay, to be able to end up getting out of here. My margin at this point, you can see I'm down about $2,400. So I'm down off of the $50,000, about 4% off of my max margin that I ended up using. Okay? So again, it's a manageable trade. The loss never got out of control, so I'm comfortable, and I'll end up keep playing the game because, sooner or later you think the market has to come down, right? I mean, we haven't been right yet. We've marched up straight 150 points without so much as a pullback, but any little pullback will end up getting me, to profitability. Okay, Tom, if we go next page. See, there's the iron condor you can end up seeing that I mentioned. The put leg is much longer than the call leg. And do you remember I said I like to take risk off the table? Well, here, because we're closer to expiration, and because I do have, a fair amount of room if we pull back, right, I figure that volatility isn't going to hurt me as much with 11 days left to go before expiration as it would if we had, say, 75. So therefore, I have a lot more, the speed at which the T+0 line morphs to the expiration graph is much faster now, right, because it's only 11 days, not, 50, 60, or 75 days. So if it pulls back, I don't worry about I don't need, 60 or 70 points to the downside room here. I need to have some. So if it pulls back 25 points, I will make some money before I get out. And all I'm trying to do is make a few dollars to end up getting this thing to be less negative or possibly, back to break even before we end up closing this. Okay, Tom, if we go to the next graph.
Well, I just wanted to point out, let me just go back a slide. If you notice, the theta is up at 300, and you're so close to expiration that as each day passes, that theta keeps getting bigger and bigger. So you don't have to spend too much time in here for it actually to get back to positive, as long as it doesn't move too much.
Tom, thank you so much. I mean, that was a much simpler way of saying what I was trying to. When I said that the T+0 line, the dotted lines, will morph towards the expiration graph at a much faster rate, but by Tom, the way Tom put it, it was saying the exact same thing, but I think easier. What happens is that my theta has gotten much, much higher. Tom, also go back to the Greeks. Okay. Now, one of the challenges that you end up having here is that you have to be a little bit careful of your gamma because your gamma can get to be very negative very quickly. Remember, the more negative gamma is, the quicker your deltas would get out of control. So what I did was that I reduced my deltas by about, by more than a quarter, and I did increase my gamma a little bit, but the trade-off on having, going from 1.3 to minus 3.3 gammas was small compared to the size of the increase that I ended up having in my theta. Now, also, you say, oh, my God, Jim, your Vega's gone up very, very high. Yes, my Vega's gone up high, but with so few days left to go, there's only so much that Vega can end up hurting you because, as you know, once you get to expiration, Vega goes to zero, right? It's got to go to zero because the thing is that there's no more volatility. So as you get closer, Vega can't hurt you as much. So I would have never carried this much Vega early in the trade, with whatever it is, less a week and a half left to go to expiration. I'm okay carrying this much negative Vega because we're so late in the trade. Tom, those were really good points to point out on the Greeks. Thank you.
Sure.
Okay. So, we end up having the market. It ends up running up a little bit more, but then it finally ends up pulling all the way back to 2070. And it's within the range. Now, I could have closed this out on Friday, okay, but I didn't. And the reason why I didn't close it out on Friday was that I was in a reasonable place, but the pricing just wasn't there. They weren't giving me any type of reasonable price fills. I didn't get any executed, by the way, in my institutional account. Not for lack of trying. Okay, I tried to, but I just wasn't willing to end up. It was kind of like they were holding on to that theta and they wouldn't give it to me. And so what ended up happening on that Monday is that we did end up getting a little bit of a sell-off. We got into the middle. They gave up some of the theta, and so when you get what you're waiting for, and this is absolutely key. This is probably one of the biggest mistakes I see traders make. If you end up saying, well, I'm going to wait for a pullback, I'm going to wait for a pullback, I'm going to wait for a pullback, like we have done now in this trade for the better part of 2 months, okay, and we've been battling it and battling it and battling it. When you finally get it, you run for the door. You don't stroll. You run for the door. You get out of the trade. So it finally ended up pulling back enough. The trade ended up getting positive, and it was time to end up getting out of the trade. Made approximately 1% on the total capital used, maximum capital used throughout the trade, and we were done with it. So that was the absolute key on the position, and so I felt that it was really it finally came to fruition, right? The thing is, people say, oh, Jim, you were lucky that it pulled back. Yeah, well, if I wasn't lucky, what was going to happen? I was going to lose 2 or 3 or 4%. I'm okay with that. Remember what I told you. What's the second hardest type of environment to end up managing the broken wing structure on? After a 1987 type market crash, the second hardest is when you have this relentless march higher, because you have to keep adjusting. So that's the way the trade will be managed going forward in the service. Okay, that we're going to provide. It's going to be the way that we're going to manage it. Remember, one of 2 environments. We're getting ready to put on our June position or start our June position. Right now, because the market is higher, volatility is lower, and put skew is relatively steep, unless things change dramatically, we'll probably end up going with the even butterfly, buying deep in the money calls. For that structure, for those of you that are big John Locke fans, you'll notice the structure is it somewhat resembles an M3. Okay. Traded a little bit different. John and I have had a lot of conversations about the way he ends up trading his M3 versus the way I end up managing, my symmetrical butterfly with the long call. But it'll end up being pretty similar. Questions? I'm just looking over here. Here you locked it. On 316, Tom, I don't remember. I'm just looking at the question. I locked in losses on 3.3. Can you go back to the adjustment on 3.3?
See, that's this.
Oh, yeah. One. Yeah. But by the way, not only did I lock in losses, but it was a great trade. It was a great trade to lock in losses. If you remember what I ended up telling you, okay, about the butterfly, always look at the pricing that you're paying for stuff. I spent $6.75 when I put on the butterfly when I originally put on the trade. When I locked in the loss, okay, for half of it, I locked in the loss at $5.65, and I took half of the position off. If you remember, I took the next quarter of the position off, and I only got $4.20, and I took the last quarter off, and I only got $1.55. So yeah, I locked in losses. It's a lot, I don't know if you've ever heard some people end up saying, and this is more in stock picking than in option picking. Some people will end up using the old expression, the best loss I take is the first loss I take, because it means that you didn't end up losing that much money. So yeah, what ended up happening is that the profitability of the trade, the amount that I was going to end up making, became too dependent on the direction. Okay, I don't mind letting things run and having, needing the market to pull back or needing the market to go up to get into my butterfly into position. But when it becomes almost a unidirectional bet, and the rest of your Greeks don't look good, meaning that your delta becomes too skewed, too positive, or too negative. All right, in our case, it kept becoming too negative. When the gamma is not going to be end up helping you at all, okay, in your position. It's time. It's time. And so, losing that $1.10 on the position, half the position that I closed on 3-3, to me, it was at the right time. I could have done it earlier and lost less money, but then if the market pulled back, I would have been kicking myself because it would have been too big of a loss. Had the market kept running up at this point, as you've seen, because I didn't close all of it, I would be losing too much money on that open butterfly. So, Tom and I and Dan Harvey and others back, okay, when we all traded, okay, and met in Sheridan, we used to use the neighborhood as, if the trade is, you need to know when the trade's starting to get into the bad neighborhood. When you first go over the railroad tracks and the neighborhood starts to get bad, it's time to start to do something. Now, you don't have to end up abandoning the trade completely, because what happens if you reverse and you go back into your good neighborhood? And that's the way this is managed. That's the whole management strategy of the way I end up doing this. Will it work? The answer is sometimes yes, sometimes no. But what I'm doing is I'm giving myself a better probability. Okay? It's still, it could end up coming back, okay, ripping back and having, the market fail completely and the floor fall out. And I would have been an idiot because I put this trade on, and if I had not done anything, I would have made a lot more money. That's going to happen. That's going to happen a lot of times. But you just got to play the probabilities. Okay. I don't know if there are other questions. I know there was a skew question, Tom. So if you give me the ball, I will end up talking about.
Sure. Let's see.
Okay. And if you just monitor the questions while I.
There's two Jim Reggio. Well, the real Jim Reggios, please stand up.
Can the one here? This one. It would help if I could spell, huh?
Well, it says it. Well, can you share on the one you need to share, or is it the other one?
I'm trying that right now, and it's the other one.
The other one, okay.
Yep, now I can share.
Okay, great.
Okay, and let me just do this. Okay, and let me get the right monitor. Okay, here we go. Okay, two things that I want to end up showing you. And it depends on what system you end up using. If you're a Thinkorswim guy or if you're anybody else, what you can end up doing is you can come over here and you can open up your June, and you can see your June is at about 15. If you map out your implied volatility and take a look at your VIX, okay, you know that the VIX right now is at 13.4, and you can see that it's always going to be a little bit higher as you go out in time. The other thing that you can end up seeing is that if you open up whatever trade you're looking at putting on, what I'll end up doing is that I'll end up looking usually at, the at the money, and maybe the, you can look at a 20 delta, you can look at 100 points below. Whatever you look at, you just have to look at it consistently, okay? So what I'm looking at is I'm looking at implied volatility here of, 14 and a quarter, let's call it, close to the money, where if I end up going down to a delta of around 20, okay, and you can see that's 120 points. If I go down just 100 points, I'm looking at 17. So it's about a 3-point difference. It's steep, but it's not very, very steep. One of the things that I'll end up taking a look at often is, and because Tom and I both use interactive brokers, what we'll end up tending to end up looking at is that live vol okay, actually clears, okay, through Interactive Brokers. And so I'll end up using a live vol tool that they have called Skew, and I should have pulled this up when you first asked, but it'll end up going through and it'll actually show you in a graphical form. So here is the graph, okay? And when I talk about put skew being flat, what I'm talking about is the steepness of this line. So if we take a look at, let's say, all of the lines, okay, and then take a look, strikes 10% up to 10% down, 10% up, first 6 months only over 25%. You can see what happens is that the 6 month out, the September one is down here. You know what, let me get rid of a bunch of these things just to make it easier to see. Let's leave that April, and then let's close out to leave the Mays. Let's leave the June, leave July, and here. Okay, maybe that. So what ends up happening is that as I go through time, as I go through September is this line over here. What happens that over time, the puts below the money have a higher volatility than the puts at the money. So when you take a look at what would I consider to be steep in not that I would be trading September, but what I would end up looking to do in September versus what I would be looking to do, next Friday or this Friday even, right here is this Friday, you can see it becomes much more steep. And so here's the implied volatility. This is the best retail tool that I know of where you can end up watching this. You take a look where your implied volatility is, and you kind of have to watch it. What we end up having is that we actually measure the difference between the at the money and the 10% below the money, and what the difference is, and we will track that over time, and we track it in terms, we measure it as a distribution, and we measure it in standard deviations. So I will always know where the implied volatility is and how steep the skew is in the way we end up doing this on our professional tools that we end up using, and we measured it in, as I said, we measured it in standard deviations. Short of that, okay, this is the best tool that I end up seeing, okay, that you can end up using, meaning live vol. If you don't have live vol, what you have to do is you have to actually keep an eye on what the implied volatility is at the money, and we tend to end up using percentages, not deltas. We've done a lot of studies. There was a big white paper by Goldman Sachs probably about 3 or 4 years ago, and they showed, does it work better using and selling options, like if you're selling naked puts, or if you're selling naked calls, are you better off selling at a delta, or are you better off selling at a percentage below the money? And the answer is, statistically, you're better off using a percentage. And the reason why you're better off statistically is because think about what happens. As implied volatility goes higher, your deltas become further away from the money. So what ends up happening is that if I'm always going to sell a 20 delta, if the implied volatility or suddenly doubles, that 20 delta, okay, may end up moving from the 1665 down to the 1865 down to the 1925. So it might move down 10, 20, 30, 40 points. So when implied volatility is higher, you're actually selling less of it because you're selling less away from the money. Then what ends up happening is that when implied volatility ends up going very, very low, you have to start to come in very, very close to the money. The problem with that is that if a vol is very low and all of a sudden you have some type of an event and the market screams down and drops, you're going to get hurt badly with it. The problem, okay, that retailers, traders don't like when you end up trading that way is the amount of money that we collect varies a lot more. When implied volatility is high, we're going to be collecting a lot more money. When implied volatility is low, the amount of money we're going to make is much, much lower. I know that a lot of retail traders like saying, well, I like to end up making, 3% per month on this. Well, tough. It's not going to happen, okay? I'd like that too, okay? It's just too difficult, okay? So what do is we play the probabilities, okay? And that was pretty much it. While I'm here, Tom, I figure I might as well end up showing a few more quick things. I can't see the questions. But what I end up doing on Thinkorswim is that I keep, every time I make a trade, I just keep it in here. I have a separate window, and I just lock down all my prices. So when I can go back and say, well, what did I originally pay for that initial butterfly, right? How many times did you hear me say I paid $6.75? Well, I opened up this window. Here was the first time. The problem with keeping it this way is that it doesn't have dates on it. It doesn't tell me what my P&L was, when I ended up making that trade. It doesn't tell me any of my Greeks back then. So therefore, you really can't do any true, any true teaching or any true post-mortem analysis, if you only have this, you really need to use option view. So, Tom, do we have any other questions here? I don't have my...
No, just some people there is one. Calculated steepness with IV and standard deviations, how the formula works, or do you have an example?
Yeah, here's the way we end up doing it. You can't end up looking at a specific, if you're going to end up looking back in history, you can't keep looking at the Junes. So therefore you have to end up doing the, what the tool does, it does the interpolation to end up saying what would the volatility of a 90-day, 60-day, and 30-day put be at 1950, let's say. And it does it at every single strike. Now, you need to do the interpolation because you don't have the actual, the next day, if we had a 90-day option, the next day it would only be 89 days. Then what do we look at? So you're not looking at apples to apples. So what we have to do is that we look at a constant 90-day. Actually, we start out at 180 and look 30 days in. So we look at 30, 60, 80. A lot, by the way, that's exactly what the tool from LiveVol looks at, So it looks at over here, it has these days here is what it looks at, right? So the problem is that it doesn't look at these and they'll change. However, if I come and I take a look at the chart, here I'm looking at 30, 60, 90, 120. So I'm looking at the implied volatility. So I can see that the longer term volatility ended up moving up. Here, let me come some more over here. I can see what ends up happening, when long-term volatility might end up moving than short-term volatility. And so I can take a look at this and I can measure what implied volatility is, and I can also see what that ends up meaning against, say, historical volatility. So the first thing you have to do is you have to do the interpolation, which is a ton of work. The second thing you have to end up doing is you have to keep a database and keep a history of that. Which is also a ton of work. And then you need to end up doing all of the mathematics to end up taking a look at your sample set size that needs to end up being at least a year long and see where you stand within the measure your variance, within a year of doing this and then calculating your standard deviations. You need to do this on any stock you would trade, and you need to do it real time. You kind of understand why we pay for a tool to do this now? It's kind of difficult if you want to end up having this, and that's the best way to end up doing it, and that's the way we take a look at it. We'd rather end up paying for the tool. All of their data is correct. We don't worry about it. But this keeping the problem with Thinkorswim or anybody else, if they plot implied volatility, they tend to only plot 30-day volatility. What good is 30-day volatility if you're putting a trade on at 75 days? You take a look at what ended up happening here, and the huge difference between where implied volatility was at 30 days versus where it was at 90 days. You shouldn't be making decisions, looking at 30-day volatility and saying, therefore it must be the same at 90 days. No, it's not.
Another question, Jim. Dan asks, what's your thought on O&E versus option view to track and assess trades?
I know a lot of people have different viewpoints on this. This is what I have found, is that ONE uses the calculations from Thinkorswim. Okay, OptionView actually does their own calculations. Okay, so therefore, and by the way, the other part is style, right? Right? It's do you like one interface versus the other? That's something you choose. To me, I guess you get used to one of them, and then it just sticks with you, right? So I've been so used to OptionView but I do like the ONE, right? Very slick interface. The problem that you end up having is that, let me uncheck one box so you can end up seeing this. If I show you the risk profile of something, and let me just, because this was locked out, I have to do it this way. Okay, what ends up happening here in the risk profile, I know if I'm looking at Thinkorswim or if I'm looking at this is probably a bad example. You know what? Let me go into. I might as well show you this, right? This is right. This is the one that's going to go out by the end of the week, right? It's me tracking all of the butterflies, me looking at everything and being able to say, okay, what ends up happening? So this is the one that I was looking at before we started here. I have a butterfly. Okay, a 100-point wing butterfly on both sides, and I bought a call, okay, at the bottom wing. And so this is what the P&L looks like. Now, here's what I know, okay. I know that if we go down, the market sells off, and we have implied volatility spike. And let's draw this out. Let's say, what does one standard deviation look like in May? Right, we pull down. Volatility spikes, and you'd say, well, Jim, you're going to make money on theta if this comes down, okay, in a few weeks. Yeah, but it's lying to me, because here's what happens. As we go down, one, implied volatility is going to go up. Two, the put skew is most likely going to end up getting flatter. So I know that the P&L here is not $1,600. I know that if I'm positive at this point, I'm happy. I know that this probably has at least $1,600, probably closer to $2,400. It's overstating it. How do I end up knowing that? Because I've traded this a long, long time. So the problem with ONE is if you're used to the Thinkorswim ones, that's fine because you've already made those adjustments in your brain. But if you're not, okay, trading like this and you're trying to learn, it's really, really difficult. I don't know if you guys remember, I gave you this example once. When I was in college, I fell on my motorcycle, okay, and I bent my motorcycle handlebars, so they were a little bit off, okay. When I actually traded in that bike and I got a new one and the handlebars were straight, I kept drifting the bike to one side because I was used to riding a bike with bent handlebars, okay. Thinkorswim is bent handlebars. ONE is bent handlebars. If you're used to your bent handlebars, that's great, okay. I'm used to them, okay. If you're not used to them, ONE is going to, OptionView is going to be a lot more accurate.
Hey, Jim, Robert asked, as a general rule of thumb for someone without live vol, would you say below 18 VIX trade M3 style and above 18 broken wing butterfly style?
Boy, Robert, that's an old school one. It's that number, by the way, Robert, I don't think you picked out of the thin air. That is an old floor trader rule. Okay, when I would end up asking him, what did you consider high, what did you consider low, 18 was the number that they'd always used to give us. So that's what they would end up doing. Yeah, probably not the worst thing in the world to end up doing. And if you forced me to pick a number, I'd pick 18. But I have seen 17 implied volatilities with very, very flat skew, and I've seen 20 volatilities with a pretty steep skew. One of the challenges that you end up having is what's causing the volatility. And so you need to end up measuring that. So in a vacuum, you pick the really good number. But what happens if we're really afraid about if the Fed raises interest rates, if that Russian jet flew a little bit too close and actually crashed into the U.S. warship, okay, over a couple of days ago, and escalate, right? You have geopolitical risk. What's causing it, the volatility to move higher? So if you're going to choose a number, that's probably the best one, but it's a lot better to end up looking at the skew. You really, really do. It's kind of like if you told me I had to predict 90-day volatility on the chart that I just showed you, but I only had 30-day. Would I use 30-day? Yeah, I would use it, but I know it wouldn't. If I could get better information, I'd always want it. The way I've used this analogy too. You guys are light years in front of the average trader that watches CNBC, right? Because if you ask them about volatility, they'll end up telling you, oh, it's this. And what will this be? It'll be where the VIX is. Okay? And that's the only thing they'll know is where the VIX is. It's a single point that represents the volatility of every strike for every expiration. Well, that's not very accurate. You're not trading a single point. What we're trading is we're trading one point against another, right? We're long this option, we're short that option. And we usually have at least, 3 or 4 of those different strike prices. So what do you end up using? You really have to know that relationship. The viewpoint that I'd end up saying, it's almost like, if you have a single point versus knowing what every volatility at every point is, it's almost like I don't know if you guys are as old as Tom and I are, but it's kind of like watching that, 12-inch black and white TV with the rabbit ears you had when you were a kid versus watching your 4K, 60-inch screen that's hanging on the wall in your living room today. So you want to have a much clearer picture when you're trading.
It's funny, Jim. Gabby and I have moved on. We're using our iMac for our TV now.
And that even has greater resolution.
Yeah,
I know
exactly.
it's changed, right? My daughter doesn't watch television at all anymore. She just watches, Netflix or other things on her iPad or her iPhone. So okay, what other questions?
That's it for the questions. Peter just said, Jim, great job. Your explanations helped a lot. So thanks, Peter. Before we wrap up, I think probably, Jim, you want to say a few words about the paid service starting, right?
Yeah, please, Tom. If you would take the ball back, and I know that you had those last couple of slides.
Oh, okay. Let me grab the PowerPoint.
Now that we finished the April trade, we wanted to end up having, we extended April because I thought that when you guys had seen the profitability, I didn't want you to end up thinking that, it's always going to be this easy. If you remember the first, if you go back to the profitability trade of the different ones, it was like the second slide I think you had, Tom.
Oh, the history.
The history. I didn't want you guys to think, this is easy. You're going to end up making, 5 to 10% every month. No, we're not. Okay. So when April became difficult and it was losing for most of the trade, I told Tom, I said, Tom, this is a really good example. I'd like everybody to see it. I don't want to shut everybody off. If anybody who's paid, let's just extend them. But I'd like them to see how to end up managing in real time, how to managing, one of the more difficult, second most difficult environment to end up trading in. So we ended up extending everything. But now that it's closed, what we're going to end up doing is that we are going to start the paid service, and it's going to start with the June trade that we're going to end up putting on. For those of you who may have been watching May trade is on right now. It's up roughly 1%. It is in a condor fashion. We had to roll it once already. Depending on what ends up happening, the plan on that will be to leave it. I'll have to adjust if we move higher. Okay, so if you want to end up having the rest of the May trade and the June trade, we are going to be starting the paid service. Tom, is it next Monday? When did we pick a final date?
I don't think we picked the final date, but Monday sounds good. We should do it before trading starts next week.
Okay, so that's what we'd like to end up doing. It's so by over the weekend, it gives everybody the weekend a chance. If you want to sign up, please sign up. A couple of points I want to end up making. I've gotten feedback, and I apologize. There was one trade notice that went out. I had been answering a whole bunch of questions for people saying, hey, can I end up trading this with less than $50,000? And I made the commitment that I would try to do it. I would try to do it for around, 12 and a half, make it a quarter. It may be a little bit more at times, but I'll try to end up keeping it, so that it's divisible by 4. My trade, and I had answered so many questions on that when I sent out the trade notice. Instead of trading 4 options, I traded a quarter of it or 1. So I sent out the wrong one. I got some notices. I think everybody realized that right away because I said we're closing out the last portion of it, and there were 4 trades there. So I apologize for that. The second piece of feedback that I ended up getting back was that, you know, in the beginning, I got a bunch of emails saying, you know, I really like this. I like the fact that I don't have to make very many adjustments. So I thought that it would be nice to be able to send out, you know, updates once in a while and only really send you out stuff with information when I was making adjustments. Well, when I did that, I got a lot more emails saying, no, can I end up doing more adjustments? So what we will end up doing is that we will send out, you know, at least 3 updates a week, okay? With probably one of those being a video over the weekend. Okay.
Yeah, I think you're going to do more adjustments. I think you meant more updates.
I'm sorry. Yeah, we don't want to do any more adjustments. This was as many adjustments as we ever want to make. Okay, this was and by the way, you'll notice if you count the adjustments, we had more adjustments here than any place else, right? Because of how difficult it was to manage. But what we'll do is that we'll send out updates, at least 3 a week. Probably one of them being a video. I tend to end up using the Thinkorswim. It's easier. It's where I end up keeping all of the graphs. I just want to make sure if anybody has any suggestions or would like to see something different, send us an email, and we'll see what we can end up doing. But that tends to be the way I do all of my analysis, because the challenge with using Option View is that I can't do what you saw on my screen, right? When you guys ended up seeing on my screen all the different butterflies, that's what I do, right? I'm watching pricing for weeks. And so I don't end up putting up on the any of the documentation of trade images and stuff. You know, here are the 7 different butterflies that I've been watching prices for the last 2 weeks. I end up doing that, and when it says, okay, it's time to end up going, this is what I'll do. If you guys want more information, I'd be more than happy to end up doing it. I could even do maybe a WebEx over the weekend if people would want to end up seeing things, but that's where we are. Tom, how do they sign up?
The URL's on the slide. You can go to cdurl.us/Kevlar2. You can also go to our public website. Let me just show that real quick. Let's see. You go to capitaldiscussions.com. On the education menu, there's the Kevlar trade alerts right here, and that goes to the same page. And you just scroll down to the bottom and pick the subscription you want, hit subscribe, pay for it, and off you go.
So, any other questions?
That's it. Looks like we've run through them. Dan said toss is good for your updates, by the way. So I think, we did have another one come in from Larry. The 2-month overlap, if using 50K, would we be able to allocate 50 per trade or have to cut it in half?
Oh, no. 50 is what I use for the account. If you take a look at when I'm using less capital, I will end up having 50 be on the total. Now, I will tell you that I've taken some liberties because I'm up, since I started on this. So there have been times when we've gone up and we've leaked up to 54 or 55. But if you started with 50 when I started, it was no problem, okay? And so 50 would be enough for the entire thing. What you'll end up seeing is that the trade that I currently have on in May is using about $26,000 worth of margin right now. So when I end up starting the June trade, I'll probably only use maybe, again, $25,000 to $30,000. I will cheat a little bit off of the 50, but never more than the profits that have been made previously on the trade.
And I guess there's one more question. Are there any brokers who have leverage for lower commissions for the community? I know we had talked to that one, Jim. I don't know if you have any updates on that, but there is one broker we were talking to about getting it's the old live vol, it's Lightspeed. I don't know if they've come up with a solution for us yet, but they've promised to.
Okay, so quick question for all of you guys. Live vol is the platform. Okay, it's a software platform. The broker, is Lightspeed. Lightspeed clears through IB, and so you get IB rates. Whether you go through, if you go IB directly, or if you go to have the trading platform be a live vol, the broker be Lightspeed, and the clearing agent be IB, it's going to be the same price. we can end up getting a dime discount per option. Minimum of $50,000 in the. I think it's 50,000 in the account, or is it 25, Tom? I forgot.
I don't think they've actually finalized the proposal yet, so I'm not sure.
Okay. It's either 50 or it's either 50 or $25,000 as a minimum, and they also have like a 3 contract minimum or something like that. So you can't just trade singles, okay, and expect to end up getting it. But we'd save you a dime a contract. If you guys are interested, just chat in here or send Tom an email, and we can set that up again. We ended up, I didn't see Joe Minton, by the way, when I went to Chicago. We couldn't end up getting our schedules. He was actually in Florida when I was in Chicago. But I can follow up with him, and if we want to end up doing it, we'd only do it, though, if people are going to take advantage of it. I don't want to end up asking them to set everything up and then have, one person, sign up.
Right.
So, Tom, maybe what we'll do is that we'll send out a survey to the community, and if they want it, we can do it.
Okay, great. Well, I think we're a little bit over time, and the questions have run out, so this is a good time to stop. So thanks, everyone, for joining us, and Jim for a good presentation. Appreciate it.
Thank you, everyone.
All right, so if you want to keep going with the Kevlars, it's time to subscribe. So this is how you do it. So I'll get this posted as soon as possible, and everyone have a good week trading and a good weekend coming up.
Bye, all.